This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and today we really have a very special guest, Harry S. Dent Jr. It might be easier to describe what Harry is not. He's not a classic economist, blindly following the Phillips curve or assuming that people make rational economic choices. Harry is more of a Renaissance man, an entrepreneur, a voracious reader about history and current trends to develop his views of what comes next. When Harry studied economics in college in the 70s, he found it vague and inconclusive. He chose the bedrock of accounting instead because the numbers don't lie. Relying on black and white data, he could quickly determine a company's health and chart a course for success. His undergraduate studies led him to Harvard Business School, where he was a Baker Scholar and was elected to the Century Club for Leadership Excellence. After Harvard, he became a management consultant, helping businesses understand where they were, what obstacles they faced, and how to succeed. He did this by weaving together research on people, technology, and markets. Since then, he's spoken to executives, financial advisors, and investors around the world. He's appeared on Good Morning America, PBS, CNBC, CNN, Fox News. He's been featured in Barron's, Investors Business Daily, Entrepreneur, Fortune, Success, U.S. News and World Report, Business Week, The Wall Street Journal, American Demographics, and Omni. Harry has written numerous books over the years. In his book, The Great Boom Ahead, published in 1992, he stood virtually alone in accurately forecasting the unanticipated boom of the U.S. economy in the 90s, as well as the multi-decade decline of the Japanese economy. In 2016, Harry published Sale of a Lifetime, where he reveals the secret behind many of the largest and fastest fortunes in history out of the great crashes that can create a profit windfall that will last few generations. Today, he uses the tools he developed from decades of research and hands-on business experience to offer readers a positive, easy to understand view of the economic future. So, Harry, we welcome you to our podcast.
Yeah, nice to be here, Bruce.
I'm going to tell the audience what I respect about you. First of all, you predict in both directions, which I don't think is normal, which means that you are looking at evidence, not you have a bias that you have to land on. That's important. That you put it in writing. And once you do that, you put yourselves in harm's way because you're going to be wrong. I've just so you know, we write reports every 2 years about what's going to happen in real estate. And once you put it in writing, you're going to be wrong. It's going to be early, late, or sometimes it actually is going to be wrong. But you take the risk of putting it in writing, and I respect that. In 2008 or 9, I do public speaking, and somebody come up to me and say, "Yeah, we knew that was going to happen." And I always ask them, "Okay, can I see your document?" Yeah, because that's, I wrote a 400-page document called The Crash. I just want to see your document because when you're making that statement, that's so easy to make, Your titles leave no doubt as to where you stand, which I respect. There's no wiggle room. You're definitely headed in one direction and can stand behind it. And I like that. I feel like you have a sound basis to start with the subject of demographics. So, and that was the first time I ever heard anybody use that. So that's what I like about what you do. What led you to do research on how the economy could be predicted in the first place?
Well, I had the intuition when I was in college that I could see these cycles, clear cycles. And I'm like, well, if things go up and down and people invest the most and buy the most houses and do all this stuff at the top and then don't see the bottom coming, well, come on, if there's a cycle, there's a reason for it. And only after I stopped consulting to Fortune 100 companies at Bain & Company and took that same strategic consulting into new ventures in the early 80s, the new ventures were appealing to the young baby boomers, the giant, massive generation that nobody saw coming, early stage. And so I had to start looking into demographics by default. Now, one thing to look at demographics, another thing in the same time frame, 1981, when the US government started year by year publishing their first demographic surveys of when people spend money by income and age. I mean, down to 600 categories, potato chips for crying out loud. So I quickly determined from that, oh my God, back then, the peak in spending in the US, in most developed countries, was 46, maybe 47. And now it's a little higher. But so shortly after that, I was consulting these new ventures, but I'd already been interested in economics, but I quit my economics major after 2 courses because it was a waste of time. All theory and all blah, blah, blah. And you know what turned me off, Bruce? Most economists said, well, nobody can predict the future. And I'm like, what? If you can't predict the future to some degree, and if there's not some predictability with all these planets whirling around us and all these things happening, then what do you mean? Why are you even in economics? So I quit economics. I studied everything else in business, but I didn't really learn about demographics and another important concept, the S curve, how new radical innovations start on a small scale with a few crazy people like Steve Jobs, and then move into niche markets and then explode at a predictable time at 10% penetration into the mainstream and go to 90% fast. So demographics and the S curve were the 2 things that allowed me, seeing it in business, to then start to project it, well, the whole economy does the same thing. And that's when I got when I first put a 46-year lag on the birth index in the United States and saw that it was almost a perfect mirror of the stock market, almost 50 years in advance, I fell out of my chair. I'm like, oh my God, I got a breakthrough here. Well, so any good breakthrough, it comes by accident, but I was looking for it and I was looking in the right places. You don't look at the old companies for the future. You look at the new emerging companies. You don't look at the old generation. You look at the new generation. I ended up looking at both at the right time in the early 80s.
The next question was going to be, what was your aha moment? And you just told me. Those are fun for a researcher when you look at something and go, holy cow, no one's ever seen this. That is so fun.
Yeah, and 1 year later, I got a 20-year lag on workforce growth for inflation. Same thing, demographics. Who would think people? Of course, you ought to ask, why would nobody think it's not people? Why would people think government policies and a little more Republican or a little more Democratic or whatever, free market or not, which have an effect, are more important than what people do predictably as they age? I just asked you right at the gate, would you rather hire a 17-year-old or a 48-year-old? Okay, in the story. Who's going to be more productive and smarter and wiser? Now there's exceptions to that, but that's how simple the economy is.
What led me down the road to try to figure out stuff was personal bad experience. So I was a real estate investor that did everything right because you couldn't do much wrong in the 70s.
Yeah.
In 89 and 90, I built 7 custom homes and couldn't get rid of them. And then I had, in 1995, my son Aaron graduates from high school and I buy him a Honda Civic for $15,600 and buy a 3-bedroom house in my hometown for $13,300. And it just dawned on me. I said, what the heck happened to real estate? And what I did is I looked in the library for articles written about real estate timing from 1970 on. I read every news article, every magazine article, and no one predicted anything in the future. And so that's how I got interested in it, saying same kind of way. I wonder if it can be figured out. And so that was my motivation.
If something that big happens, a real estate boom and then a bust, come on, you tell me it happened by accident, by a lightning strike? Of course there's a reason behind it. And people always think, oh, it's because the government had good policy or interest rates were lower or higher. And that matters too. But interest rates are totally determined by demographics as well. Older people mean lower interest rates, and young people, unproductive and expensive, mean higher interest rates. Young people mean inflation. Mid-age people mean a boom, and older people mean deflation, like we're happening now. No matter how much money they print, guess what? We don't get inflation. Not a surprise to me.
That's interesting. Yeah, I love charts. A lot of people in real estate, very high up people that are in charge of other people's, swaying other people's opinion. A very common comment is, of course, when interest rates go up, prices go down. And you only need 2 charts to go and see if that's true. And you need a chart for the 70s and interest rates doubled.
Hey,
and prices
they were the highest in history, and real estate boomed.
Yep.
Exactly, Bruce.
Yeah.
That was one of the wake-up calls for me. That means you have to dig deeper.
Yeah.
Okay.
That's right.
Interest rates were up because of the unproductivity of the declining of the old generation and the new young generation. But the new young generation was starting a rising demand for real estate at the same time. So two different things. You had real estate going up, and I also realized stocks don't like inflation, bonds don't like inflation. Real estate is one of the real estate and gold are two of the best correlators with inflation. If inflation goes up, the price of your house goes up because it would cost more to build a replacement.
See, what you just said, again, in studying this, I was able to get access. And I mean, literally, I'm the only human being other than the inventor of this report that has access to the vault, where they have one report a quarter for some of the years in the 50s, 60s, and 70s. And so because I did the research, he respected that. I got in the vault. And what they did, which was incredible, in the 70s, they actually took per year the same house and they charted the breakdown of the cost to build it for a decade. And I realized, holy cow, when I own a house, I own a basket of commodities. And then there's a correlation between new home and existing home. And only 4 times in history have they crossed over where existing homes are more expensive than new. And it's because demand, and that we just had that in December of 2020.
Exactly.
The 4th time.
Low inventory and high demand of homes. And in fact, it's more low inventory than high demand from my view. So yeah.
It's well, we're going to get to the asset classes, but we'll get to what you think is going to occur, because we have people that are listening that have assets in a lot of these classes, predominantly in real estate. One of the things that happens to demographics, so you and I maybe are about the same age. I'm 68. And so
I'm turning 68 a week from now.
Okay.
So we're the same age.
So there's some stuff that's happened when you look at demographics. There's things that have changed. So we have a longer lifespan. So how has that changed some of the outcomes?
Well, I tell you, that's a really excellent question, Bruce, because the standard of living of the everyday person in the United States and developed world has gone up 8 times in the last century.
Wow.
But the average life expectancy has gone up from 50 something to almost 80.
Yeah.
People live longer, they spend more, they earn more, they contribute more. It's like anything. You start a new business, it's an investment, it costs money. Do they pay off or not? Well, if you have babies and they live to 80 or 100 instead of 40 or 50 or 60, of course it's better for the economy. And of course, these demographic trends I'm talking about, demographic trends are really about the workforce. How many young people enter at age 20 on average, and how many old people exit at age 63, 64 on average. And that's going up over time. So if people live longer and work longer and exit later, and if there's younger people born more, which is not happening now as much, then that increases. And this stuff, Bruce, it's predictable. I mean, the rate of people die and the young people being born, it's one of the most predictable things on earth, and economists don't look at it.
What about the change in the household structure, where you have a lot of now single mom or single adult households and less kids? How does that impact what you?
Well, actually, in a way, if you have more households per family size, it just means you need a little more real estate. Okay. I mean, you need a certain amount of space, but a single mom with 2 kids versus a married couple with 3 kids, okay, you're talking 3 versus 5, but the house is not going to be as much larger on average. So I'd say, the fact that we're having more households and fewer, smaller families with the same population or growing slowly is actually a slight, not a big, but a slight benefit for real estate. But it also tells you need smaller houses instead of larger, and more apartments than, make mansions, that sort of thing.
Okay. When you have predictions, as anybody that does predictions do not happen on a timely basis, what is your process to reevaluate? Why?
Well, I've gotten, Bruce, every major innovation. I just started out with the simple spending wave, 46-year, lag on birth index, which first I had to adjust for immigration. I realized, well, wait a minute. In some countries that doesn't matter, but in the U.S., immigration's a big deal. And so I had to, my forecasts were underperforming what would happen. When I was so bullish in the late 80s, early 90s, people thought I was a madman. I realized, immigration is augmenting this. So you have to adjust for those sort of things. And I found that, there's other indicators, geopolitical. I mean, there were 20 years we've had difficult Mideast crises and terrorism and all this stuff. This is not an accident. This happens for about 17 to 18 years, every 35 years. And now we're actually, look at everything geopolitically. Al-Qaeda is declining. Our worst terrorism is people at home, getting pissed off because they're falling behind the success of others. So it's so that, but most important, Bruce, I found a technology cycle and technology. So people going from unproductivity, teenagers into the workforce, into peak spending and productivity in their mid to late 40s, that's huge. What's bigger is new technologies, like the personal computers that then got linked on the internet, and now blockchain, which pulls all financial assets and things of value onto the internet. Oh my God. I mean, this is huge. I just was doing an interview earlier this morning. I said, just 10 years ago, my research took 3 full-time research assistants. You know what it takes now? I split 1 with my partner.
Wow.
3 to a half, because the internet allows me to go quickly and identify things I want to go to. And then I don't tell some poor person, I need to find this, find it. No, I find where it is and then direct it to them, and they jump on it and they do all the hard work of the charts and fleshing it out. That tripled, quadrupled my productivity. So internet's great, but blockchain, financial assets, everything's going to be on blockchain. Not now. Blockchain's in its infancy. You know what happened? The dot-com stocks bubbled up in 99, 2000 and crashed. You know how much they crashed? 94%. That's going to happen with blockchain here, I think, and the Bitcoin and stuff. But then they're going to boom for the next 10, 15 years like the internet stocks did, dot-com did. So innovation, new things, the best thing, more people is always good. But the best thing is that new technologies that take what we do now and make it 10 times more productive, like the assembly line. I tell you, there's one important person before modern day time, Henry Ford. The assembly line was the most important innovation of the early 1900s. Everything went to the assembly line after he proved it with cars. And that's what created, we didn't have a middle class before that. We did not have a middle class. There were rich people, a few merchants, and then a bunch of poor people. That was life before the assembly line made everyday people productive and smarter. And now computers and the internet. And I've been working from my home since 1989. You know how much money I save on real estate and office costs and dressing up every day and blah, 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 blah. I'm telling you, and I don't even have to, I don't even have to brush my teeth some days, I'm saying, it's massive. I probably save 2 hours a day from working from my home, not to count the real estate cost of paying for a freaking office that I didn't have to commute to. So
what you're talking about is
make us more productive.
As far as original research that I did, first of all, this was 95, but I just went to libraries. I studied data. I had to handwrite all the stuff, every category, all that stuff I did. Took me 1.5 years to get all the data together to where I could actually draw or write a first report. So I get it.
Well, now you can get that. I did the same thing, Bruce. Literally in the early stage of my research, I was running companies part-time on the side in trouble, turnaround manager, and sitting at home reading through 10,000 pages of the history of Western civilization and charting out things over time by hand, which I don't have to do today.
You know what though? I tell you what, I bet you're glad you did it, because I am too.
I am, because by doing it physically it implants in your brain deeper. I mean, you're right. I learned a lot about that. But if I still had to do every chart like that today, I'd be wasting a lot of time for my newsletter subscribers.
You know, I don't have a formal education, so I have a high school diploma, and I've been honored to debate many PhDs in economics. And the reason I can do that with confidence is I went to the library and hand did it all. So I know why I'm saying what I'm saying. Yeah. I was going to make this statement because this is true in my life. It's true in anybody that predicts. The enemy of accurate predictions is intervention and systemic events. And so I'm going to go back to the around 1980 and Paul Volcker. That was when they raised interest rates a lot, and he was in front of Congress, and the builders were there, and they basically said that you're destroying our business. And his comment was, "Well, right now I have bigger fish to fry." And that was interesting. Well, since then, it seems like we're headed in a different direction. So the Fed has a number of tools: lowering interest rates, buying assets, giving out money. And there was a quote, I just looked it up this morning. Jerome Powell said that this was about 25th November, 2018. He was happy with the quantitative tightening and that it would continue. And by December 16th, the stock market had dropped by 3,000 points, and that was the end of that.
Yeah.
And so why the change in policy now really directed toward helping asset prices instead of whatever the bigger picture is? Why is that the concentration?
Very simple answer, Bruce. The baby boom peaked in spending, as I predicted 25 years in advance. It would in late 2007. And the economy slowed down, and everything they did at first to try to get, nobody needed to spend more. Nobody needed to borrow more. People borrow the most, in their 40s, spend the most just after that. And what they did was by accident in the 2008 downturn, when it got so bad and looked like the next Great Depression, which is what I was predicting coming back, that it'd be like 1930. It looked like 1930, and they said, holy cow. And Ben Bernanke back then had studied the Great Depression, studied it, never done it, never been there, like most academics and economists. And he said, oh my God, we can't have this. It'd be the highest unemployment stuff. So they just started printing money. Now, they thought when they lowered interest rates and printed money, made it more available to the banks, first to bail out the banks, but to give them more liquidity, people would start borrowing again. No, they didn't need to borrow. So they finally realized, oh, wait a minute, though, when we did print all this money, stocks went up and real estate went up. Oh, well, that at least makes the top 10 to 20% that owns most of that feel richer and spend a little more money. So they ended up stumbling into this quantitative easing. They thought they were supposed to just do it to get over the 2008-9 crash for a year. Then they realized the economy was so weak, they had to keep doing it more and more. And now, Bruce, in the last year and a half, if I combine monetary stimulus and the new fiscal stimulus programs, and I haven't even counted the $4 trillion versus the $2 trillion infrastructure plan now, but 55% of GDP. 55% of GDP to stimulate a dead economy in hopes it'll grow another 2% again, like it has, or 1.5%. This is insanity. This is these central bankers don't know their you-know-what from a hole in the wall. They do not. They're academics and politicians never want a down economy when they're in. So everybody's into this. Well, if we just have to keep printing money to keep this going, that's what we'll do. And they even get Warren Buffett to sign off on this. I'm like, I'm sorry, Warren Buffett, shut up. Manage money. You're a hero at that. Shut up. He doesn't know anything about economics. And he said, shut up, because people trust him. And he's saying, oh, this printing money out in thin air, as if you could create prosperity out of that, is a good thing. They're just helping the economy. No, Warren, it's not a good thing. They are setting up the biggest fall and crash in history. That's all they're doing.
When the Fed balance sheet went up from about 4 trillion to almost 8 trillion now, what is it that they bought, and why did they do what they did?
Okay. People say they're just what they do. It's not like fiscal stimulus of recent, which is actually a better way to go if you have to stimulate. because they're actually giving money to consumers or businesses to turn
Right.
around and spend. They're just buying bonds, high quality treasury and agency bonds. So they say, well, they're just buying bonds. No. They are injecting more money, trillions of dollars, into a fixed financial system of bonds, real estate, and assets. And those money, it starts in bonds. Where does it go? They buy those bonds, and those people reinvest in higher yield bonds or higher yield real estate or higher yield stock. And so what they're doing by doing that is pumping up financial assets. They're not giving it to businesses or consumers, which also to me is bad because it causes people to overspend, overexpand, overborrow, which you also pay for later. In this case, all they've done is created the greatest financial asset bubble in history. And Bruce, let me put a number on that you will not hear from anybody else, okay? It took me a while to get to this because it's not, nobody publishes it, and you got to pay 525 trillion, right? 525 trillion globally against 80 trillion in GDP, 6.5 times our GDP. We now have financial assets of stocks, bonds, and real estate. And you say, well, whoa, is that bad? Yeah, normally that'd be 2 times GDP, and at worst 3. So we have the greatest financial asset bubble in history. We first had a debt bubble start to fail from overborrowing and overstimulus after the baby boom turned down. Well, when stimulus couldn't stop that, they realized, oh, well, let's pump up financial assets because that'll at least make people feel temporarily more rich. Only the rich, by the way, not the average person. And now they got the biggest financial asset bubble in history. So guess what? Here's my end game here. 525 trillion gets cut in 40 to 50% down to reality, maybe more. $250 trillion globally disappears forever or for a long time. That's why we go down. That's the Great Depression ahead. And it's not going to last that long because we've already been struggling for years and years. We just have to flush the excess debt and financial assets out of the system. I think that'll happen in the next 2 to 3 years, but it's going to be painful. They put this off. Instead, I tell Bruce also, if we'd have just let the 2008-9 recession go on another year and a half, like 30 to 32, and flush out the bad companies and the bad debt, which we didn't do, we'd be over this. We might be struggling to come out until the millennials come along, which is not till 2023, 24, but we wouldn't be at the precipice of even bigger downturn than we've seen since 1930, 32. So I think this won't be as bad as 30, 32 because governments will keep supporting a bit. This is going to be worse than 2008-9, guaranteed, and it's not going to be over for stocks until at least late 2022 or early 2023. And the economy's not going to really come out of this until about 2024. So hunker down.
You gave an asset value. What's the debt attached to that? I'm just curious.
The debt's about half that. The debt's about 250, 260 trillion. That is record levels, okay? That is higher than ever. Again, you have to compare everything to GDP.
Is that ratio normal? Is that ratio 2 to 1 normal, debt to asset?
No. The financial assets usually would not be that much higher. So again, the debt was already stretched compared to anything in history. And then when they found out that stimulating the economy didn't help spending or borrowing because people didn't need to, they ended up doing it just to pump up financial assets. So it's the financial asset. Back in 2007, that crash was both things. The baby boom slowing down, which triggered a debt bubble. I was not just warning about the baby boom peaking in 2007. I was warning about the greatest debt bubble in history. Well, the financial asset bubble was created to offset the debt bubble. And now I tell people, forget the debt bubble. The biggest threat to the economy is the financial asset bubble. It's 525 trillion in assets.
So
still going up.
What's interesting, we interviewed an economist that we've interviewed quite a bit, and I have a lot of respect for him. And they do an annual report. And in the beginning of 2020, they do a 3-year projection, and they had 2021. This is January of 2020, saying that 2021 GDP growth would be 2.0. So this year they have the report for 2021 at 6.5. So I went, okay.
Well, that's after a downturn. So that's not realistic. Yeah.
No,
That's
well,
not
what's
reality.
interesting about that GDP growth, I went backwards, because I like charts and go, okay, where were we last at 6.5%? That was 1983. And then I looked at the Fed fund rate. It was 10, not a quarter. And you just go, wow, that's an amazing, you just realize if you have 6.5% GDP growth, it's on the backs of nonsense.
Yeah, it's entirely fiscal and monetary stimulation. It's not real spending. How many times have people refinanced their house or traded up to a better house and gotten their kids in a better school? I mean, there's a limit where you can't do this anymore. And the problem is not that the economy will fail as much as financial assets will finally fail. There's a point where anybody that trades stocks, which I've done for a lot of years, the smart money drives the market. When the smart money decides this thing's just too crazy and over, and they start shorting it, it's over. I'm telling you, it's the 525 trillion of financial assets starting to come down to reality that's going to tank this economy, because demographics are already near their low point, in our cycle, and government stimulus is offsetting that. It's the financial asset bubble that these stupid douchebag economists created to solve this problem that's going to kill them. They created a financial asset bubble that's bigger than their dumb asses, and that's what's going to kill this thing. You wait for stocks to go down. I could see 40 to 50% in the next 2 to 6 months. That's what's going to start a big problem.
That's going to do it for part one of our interview with economist Harry Dent. Please join us next week for part two as we lead into Bruce's second quarter report on Saturday, May 15th, titled The Impact of the Next 9 Months.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.